Most people fear debt. They are told to avoid it, to reduce it, to eliminate it. But governments borrow constantly. Not occasionally, not temporarily, but structurally. Today we answer a powerful question. Why do governments love debt? Is it a responsibility? Is it necessity? Or is it part of how the system is designed? Let us break it down. This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. When individuals borrow too much, they can go bankrupt. Governments operate differently. A sovereign government that controls its own currency cannot run out of money the same way a household can. It can issue bonds. It can raise taxes. It can print currency. This changes the mechanics entirely. Government debt is not managed like a credit card. It is managed as part of macroeconomic strategy. When a government runs a deficit, it spends more than it collects in taxes. To finance the difference, it issues government bonds. Investors, institutions, pension funds, and even central banks buy those bonds. In exchange, the government promises repayment with interest. That is public debt. But here is the key. Government bonds are also financial assets for someone else. One entity's liability is another entity's asset. Debt becomes part of the financial system. Governments use debt to stimulate the economy. During recessions, private spending falls. Consumers spend less. Businesses invest less. To prevent collapse, governments increase spending. Infrastructure, public programs, relief payments. If tax revenue is insufficient, they borrow. This borrowing injects money into the economy. It stabilizes demand. Debt becomes a stabilizer. Raising taxes is unpopular. Cutting spending is unpopular. Borrowing delays the pain. Debt allows governments to fund programs today without immediately increasing taxes. The cost is shifted into the future. Future taxpayers absorb the burden. Politically, this is attractive. There is a deeper layer. Inflation reduces the real value of debt. If a government borrows $1 trillion today and inflation rises over time, that trillion becomes easier to repay in real terms. Inflation erodes purchasing power. It also erodes debt burdens. This creates an incentive structure. Moderate inflation can make large debt more manageable. Government bonds are not just borrowing instruments. They are tools for monetary policy. Central banks buy and sell government bonds to influence interest rates and liquidity. Government debt becomes the backbone of the financial system. Banks hold government bonds as safe assets. Pension funds rely on them. Global investors use them for stability. Debt becomes infrastructure. Most people think debt should eventually be repaid, but many governments roll debt over. They issue new bonds to pay old ones. As long as investors trust the system, this continues. The key variable is not total debt. It is sustainability. Can the economy grow faster than the interest burden? If yes, debt remains manageable. If an economy grows, tax revenues increase. With higher income and production, governments can manage larger debt levels. Debt to GDP ratio matters more than absolute numbers. If debt grows slower than the economy, sustainability improves. Growth masks debt expansion. Because government bonds are considered low risk, stable governments rarely default. In uncertain times, investors run toward government debt. It becomes a safe haven. This demand allows governments to borrow at low interest rates. Cheap borrowing encourages more borrowing. Modern economies are built on credit. Households borrow. Businesses borrow. Governments borrow. Debt fuels expansion. It accelerates investment. It increases consumption. Without debt, growth would slow dramatically. The system depends on leverage. Debt is powerful, but excessive debt combined with slow growth creates risk. If interest payments consume too much of a budget, governments face pressure. If investors lose confidence, borrowing costs rise. If inflation spirals, stability weakens. History shows that extreme debt mismanagement can lead to crisis. But moderate debt, it is normalized. Cutting spending sharply during downturns can worsen recessions. Borrowing allows smoothing. It prevents unemployment spikes. It sustains public services. Debt buys time. Time stabilizes economies. Here is the core truth. Modern economies reward growth. Growth often requires spending. Spending often requires borrowing. Low interest rates make borrowing attractive. Inflation reduces real burdens. Investors demand safer assets. The system encourages debt, not because of recklessness, but because of structure. Not necessarily. Debt used for productive investment can increase long-term growth. Infrastructure improves productivity. Education increases human capital. Technology improves efficiency. Debt used purely for consumption is more fragile. Purpose matters. The real risk is not debt alone. It is imbalance. If debt grows faster than economic output for too long, pressure builds. If interest rates rise sharply, strain increases. If growth stagnates, sustainability weakens. The balance between growth, inflation, and interest rates defines stability. They love it because it funds growth. It stabilizes recessions. It delays political pain. It supports financial markets. It integrates with monetary policy. It is easier than raising taxes. Debt is not a bug in the system. It is a feature. Government debt influences inflation, interest rates, taxes, investment returns. Understanding debt helps you anticipate macroeconomic shifts. It explains why money supply expands. It explains why asset prices rise over time. It explains why inflation cycles repeat. Governments do not borrow by accident. They borrow because modern economies are structured around credit. Debt is not inherently evil, but it must be managed. Understanding this shifts perspective. You stop reacting emotionally to headlines. You start analyzing structure. Because when you understand how money works, you understand why debt is central to the system.